Hey, hi everyone. Thank you for joining in. Another Saturday, and we have another interesting webinar session for all of you. Thank you for taking time over the weekend, like you always do. Um, I'm Webhav, Chief Business Officer at Grip, and the host for the evening. I have with me Nikhil, founder and CEO of Grip, and Rishabh, our AVP of New Initiatives and Credit. So let's start. And just before we delve into the topic that we'll discuss today, we are also continuously innovating on our new programs like early access programs for our products. You might have seen SIP for corporate bonds. Usually we pilot these programs with our most engaged users. So I'm sure some of you are our most engaged users, but yeah, keep an eye on these kind of programs as well. So diving right into it, Nikhil, if you could just give a recap of Grip like we always start. But I was just thinking uh, about this question before the webinar, and generally we are launching new products one by one, and like one product gets added to the train like a coach every day. But I think, could you just take our investors through the SDI journey? That would be really helpful on how we are evolving.
Sure, Vaibhav. Good afternoon, everyone. Good evening, everyone, and thank you for making the time. You have this slide in front of you, but maybe we'll just focus on Vaibhav's question, which is the SDI journey. For a lot of you, you may have heard of us talking about this term since last year. To be honest, we were very fortunate to come across this SEBI regulated framework that allows us to create these products, and it has then been a journey of adding these multiple instruments as well as creating more diversity for our users. But if I take a step back in terms of what we were looking to solve for, I think in the 3 years that we've been building Grip, there were certain common things our users frequently told us as suggestions. Number one, they wanted the products to be SEBI regulated. It provided a deep sense of comfort that a regulator is overseeing the structure of these products, which includes that there is a trustee in the middle overseeing all cash flows. The second feedback was that it is very difficult to differentiate the credit or the risk of one product versus the risk of another product. And if there was an external party like a credit rating agency who could do this job, who could give at least an indication of this, it would be helpful. I think we were able to do that in the SDI product by working with agencies like CRISIL, ICRA, India Ratings to provide an external indication of the risk. The third feedback was that it would be better if it is listed, because then it will be tradable. And the bigger convenience is that as a user, I can hold it in my Demat account, making the transaction experience very, very easy. I think the last feedback was to reduce the tax leakage or to make the the structure more tax efficient. And because of the listed nature of the STI, there is a lower taxation on the instrument as compared to our previous transactions. What it also did for us, these are the points that our users asked us. But to Webhav's point about how we've expanded it, I think it allowed us to say we do not need to limit ourselves or our users' access to just one type of product like leasing. We could actually use the STI framework to give our users access to many, many more products with the same user experience, same KYC, and all those other benefits of being regulated, rated, and listed. I think one of the most exciting things that Grip has done is to be able to create products like LeaseX, which were our staple products on leasing, but also expand the same framework to InvoiceX and LoanX. Very simply, LeaseX is based on lease receivables, leasing. InvoiceX in the same way is based on invoice receivables, and LoanX is based on loan receivables. We're proud to have already completed over 100 crores of SDI transactions between LeaseX and InvoiceX, and today we're going to talk about LoanX. This to us is probably one of the most exciting products that Grip has come out with, the LoanX product. It is a product that truly goes to the mission of Grip. A staggering 1.6 lakh crores, which is close to $20 billion of securitization of LoanX happens every year. And we were shocked to find out that only 100 investors get to participate in it. GRIP's mission has been to make available these institutional investments to a broader set of investors, including people like ourselves, who are investing our personal money. And LoanX has been that big enabler. We've been through this product, being able to provide our users access to that $20 billion of investments that happen only to 100 investors by now opening it up to everyone. And we'll speak much more about it during this webinar.
Yeah, absolutely. And as you said, between LeaseX and InvoiceX, we have now done 100 crores of investments. So our investors, the audience on this webinar, are no longer strangers to LeaseX and InvoiceX, in specific to LeaseX. But as Nikhil mentioned, some of these figures, LoanX is truly the democratization of that access that GRIP has been working for. So moving on, Nikhil, could you just elaborate on this opportunity of LoanX? What does this mean as an asset class?
Absolutely. Once again, I link it to what I just said. LoanX is about loan receivables. And we've broken down the product into 4 simple steps. Step 1, which we are all very aware of, NBFCs. And we've mentioned 2 here, the ones that we work with currently, Kirtana and Vedika. But these could be NBFCs that you may have come across, including, say, an Incred, a Clicks Capital, or even a Navi FinServe, right? NBFCs like this, on a regular basis, give out loans. These are to individual businesses, groups of individuals. And against these loans, they expect a monthly return of principal and interest payments. We have all been on this side of it. We've probably all taken some or the other loan in our life, and a bank or an NBFC has given that loan to us. What happens very commonly, and something that accounts for $20 billion of transactions, is such loans are assigned to a trust. And the payments that are coming from these loans are also assigned to the trust. So the NBFC, as a way of raising money, assigns its existing loan book to a trust. It continues to continues to meet the obligation of servicing these loans and working with the borrowers to ensure timely payouts. What GRIP has done is to work with these NBFCs to now convert this into a product for retail investors. One of the big steps there is to add a layer of security. Not only is an investor getting the fixed monthly returns, but the NBFC puts significant skin in the game, takes significant exposure, or continues to take significant exposure by putting a fixed deposit in the form of a cash collateral, providing over collateralization, and an excess interest spread. And we'll explain these terms to you during the course of this conversation. We've been able to convert or have the trust issue SDI units to investors such as those on this call, and be able to participate directly into this pool of loans, but with the additional advantage of the security cover and the servicer and the originator still being the NBFC. LoanX, hence, is the securitization of these loan receivables through a SEBI-regulated trust directly into your demat account.
Yeah. So we'll talk about all these terms like cash collateral, over collateralization, and Rishabh on the panel will also go in more details about the opportunity. But if you have any question at this point, please feel free to put it in the Q&A box. And maybe Nikhil, as we talk through the opportunities, this will become clearer. So let's move on to the first opportunity, which was LoanX with the NBFC Kirtana. This is an opportunity that we launched maybe 10 to 14 days ago. And if the investors on this call, if you did not attend our last webinar, that was with Mrs. Padmaja Reddy, who's the founder and MD of Kirtana NBFC. You should definitely have a look at that if you're interested in LoanX as particular. It was a very insightful discussion from the NBFC vantage point as well. Um, uh, but I'll hand over the mic to Rishabh now to just take us through this opportunity that we launched last, and then we will move on to the next one that we have today.
Sure. Thanks, Weber. Good evening, everyone. Thanks for joining in. Am I clearly audible or there's an echo?
Do try now. Still, can you go on mute?
Go on the mute.
Hello? Yeah, now it's better. Yeah,
Rishabh, go ahead now.
sure. So the first LoanX opportunity which we launched was with Kirtana NBFC, as Weber mentioned. So that was is a A minus rated transaction which is available for our investors with a deal tenure of 17 months. Total deal size is 20 crores, and the returns which are being offered to investors is 13.5% IRR, which turns out to be a multiple of 1.1x. This opportunity, wherein the underlying loans of Kirtana are securitized for investors, entail monthly cash flows to investors in form of principal and interest, and the underlying pool consists of around 2,500 borrowers. So it's a very granular pool comprising 2,500 individual borrowers with different business, uh, different nature of businesses of these borrowers, right? So in other words, no single borrower constitute more than 0.1% of the overall pool. So it's amply diversified. Along with these features, there is a security package available in the transaction. So the three components of security package are: one, there's an over collateralization of around 11%. So over collateralization means that there is a additional loan cover in the transaction. In other words, the total loans assigned in favor of the trust or the pass-through entity, say for an example, is rupees 100 or 100 CR for an example, right? Out of which the total pool subscribed by the investor will be 90 CR. So the cash flows which will be available to the investors would be pertaining to the overall pool. So there's a buffer cash flows available for our investors, and trust can dip into the cash flows from their buffer pool of 10% in our example, and in this case that buffer pool is 11%. It provides additional liquidity for the trust to manage any exigencies or any delays in cash flow. So apart from over collateralization, the second very key aspect of security package is cash collateral. So cash collateral is simply an upfront liquidity. It's a FD which is available with the trust, which is in 5% in this case, and trust can straight away dip into this cash collateral to pay investors if the regular monthly cash flows are impacted due to any circumstance, right? So these two instruments are these two. Apart from these two security components, the third component is excess interest spread. I know we have spoken about it in the last webinar also. So excess interest spread in this transaction is around 16%, 15.5% to be specific. And this actually means that the underlying loans have a additional cash flow stream in form of excess interest, which is available. For example, the underlying loans have a certain coupon, and there's a gap in the coupon which is being offered to investors. So therefore, this excess cash flow stream, which is in form of excess interest, is also available with the trust, and this can be utilized by the trust to pay investors as equivalent to the other security components. So this was some key features about our last or which is still live on our platform, the first LoanX opportunity which we launched with Kirtana.
Maybe just to add to Rishabh's point, what really excites us as a team about this product is the point around diversification and security, right? And then anything on the tenure and the returns can obviously be linked to that. But for an investment of say 1 lakh rupees, the number of borrowers or number of loans in this instrument are 2,500, which means every loan is only given 40 rupees of your investment. In addition, the first 17% sorry, first 16%, which I'm calculating by saying over collateralization of 11% and cash collateral of 5%. So 16%. The first 16% of the loss is effectively borne by the NBFC, that is Kirtana. Over and above that, if there is some gap in the interest, there is a 15.5% EIS spread or excess interest spread that protects returns. The combination of diversification and these security measures, in our view, really impacts the quality of this pool, which is why a rating agency like CRISIL assigned it an A minus rating, which is an investment grade rating. And against that, the returns we're able to offer in this transaction are 13.5% IRR.
Yeah, thanks for pointing that out. And for our investors' benefit, if you recall Invoice X, even there we spoke about diversification and security package, which is vastly different from all kinds of invoice discounting alternatives that are present today. We are taking the same philosophy and applying to the products that we are launching today and we will launch tomorrow. Yeah, moving on, Nikhil, if you could just quickly introduce our second opportunity in LoanX, and then again, Rishabh, if you could take us through the details of the opportunity.
Yes, absolutely. So we've used the same material, same slides, you can see, but this is a second opportunity called LoanX Vedika August 23. Vedika is another NBFC that we have partnered with. This is an NBFC that is by itself rated A minus and has about an AUM of over 1,000 crores. We're excited to bring a second LoanX opportunity in a very short period of time, once again representing the excitement that we and our users have shown towards this product and the opportunity in the market. It also brings together a larger pool of loans and a different set of use case of the loans. And I'll allow Rishabh to just talk about it in detail in terms of this product.
Sure. Yeah. Thanks, Nikhil. So this second LoanX opportunity is with an NBFC called Vedika. Vedika is a quite a established name in the industry, right? So this opportunity is rated A by Care and is with a tenure of 19 months. The total deal size which is available for our investors is 14.5 CR and comes with a pre-tax IRR of 12.7%, which turns out to be a 1.1% multiple, right? And similar to the last previous LoanX opportunity, this also consists of monthly cash flows which will flow to investors uh, in form of principal and interest, right? And the underlying pool is in fact even more granular in this case. It comprises of what 4,000 individual borrowers. These are retail borrowers, and therefore provides diversification in the pool. And now, yeah, if we talk about security package, similar to the previous one, the similar three components, but the quantum or the magnitude is different in this one. It has a cumulative cash collateral and over collateralization constitute 22% of the pool, right? This is the maximum upfront liquidity in form of cash collateral and over collateralization which such a transaction can have, right? So over collateralization is 10%, which again is a buffer loan pool, buffer loans which are available in the transaction. Again, the trust would have access to the cash flows from these incremental loans. And cash collateral is again 12%, which is upfront liquidity, upfront FD available with the trust to dip into. And EIS is 13.8% in this transaction. So I think there are a couple of questions on EIS as well in the Q&A box, right? So I will again talk about it just to briefly describe what EIS is, right? So, for an example, the underlying pool has a weighted average interest component of, say, 15%. Just an example, right? So, the cash flows from this 15% coupon will flow to trust first, right? And if the coupon which is available for the investors as part of the transaction is, say, 10%. So, since the cash flow is a higher stream, particularly for interest, right? So these additional cash flows would first flow through trust. The cash flows for that would come in trust's bank account, and therefore these incremental cash flows will be available with the trust and can be utilized to pay investors if the regular cash flows are impacted. So therefore this excess interest stream is available with the trust to utilize in these kind of transactions, which is termed as excess interest spread. It is 14% in this transaction. So yeah, better, yeah, around 22% upfront liquidity and excess interest rate of 14%. This is again a very granular pool of 4,000 retail borrowers, and yeah, so that's some key features of the transaction. Nikhil, Weber, if you want to add anything.
No, just let's just move forward, and maybe if we can talk a little bit about
Sure.
about the specifications of the pool itself.
Yeah, definitely. So this underlying pool is a JLG loan pool. JLG essentially means joint liability group loans. It's a very significant portion of NBFC's market in India, and JLG loans means that people collectively with same kind of businesses take loans from an NBFC. So these kind of JLG loans are pooled in the transaction, and in order to mitigate some of the inherent risk of this transaction, what we have done is, say if there's a group of four people who have taken loan from an NBFC, we have deliberately not included all four people in this pool. We have very selectively only included one of those borrower of from that JLG pool in our transaction. So therefore this is fairly diversified despite of being a JLG loan pool, right, of 4,000 retail borrowers. And if you see, the ticket size is quite smaller. Around 45% of the borrowers are in the range of with a ticket size of 36 to 45,000, and then in the 46 to 60,000 ticket size, then the remaining 39% of the borrowers are there. So therefore, it's a fairly diversified pool with a smaller ticket size. And if you look at the geography wise exposure, this is again diversified amongst total in 7 states, out of which you can see on screen the exposure in top 3 states. Yeah, similarly, the purpose for which these people take loans is again further diversified. Some people took this for business purpose, some for agri allied purposes, and this Vedika is also focused on female lending. So therefore, you would see a slightly higher portion of mix towards female borrowers. 96% of the borrowers are female in this, but that's after. So we, in our discussion also with Vedika, they also, based on their research also, they which clearly indicates that female borrowers are better borrowers in terms of servicing the pool, and the rates of delinquencies are also are lower as compared to male borrowers, based on industry research as well. Yeah. So that's how the pool is diversified based on ticket size, geography, and the nature of loans.
Yeah. I would just like to add that apart from this diversification, RBI, which regulates NBFCs, also puts in place certain minimum criteria for what the pool should consist of. For example, one of the criterias is that the loans must be at least 3 to 6 months old and should not have had any delays in payment. There should be no defaults. And that is a mandatory criteria from RBI for all such transactions. So, in addition to the selection that is being done here in terms of achieving diversification, as an investor, you're also getting the benefit of certain RBI rules for securitization of such loan pools. Rishabh, back to you to maybe talk a little bit about also the return structure.
Yeah, and Rishabh, if you could also just touch upon the taxation part of the instrument, that'll be good.
Sorry, I was speaking on mute. Yeah, sure. So first to talk about taxation first. The cash flows which will flow to investors every month will be split into principal and interest, right? As these are in any PTC or STI transaction, right? So the only interest component is taxable in hands of investor, and trust will also deduct a TDS, which will vary from 25 to 30% based on kind of investors who are holding this instrument. But only the interest component will be taxable in the hands of investors based on their marginal tax rates, and this will be classified as part of other sources. But we definitely advise you to also take consultation from your tax advisors if you want further granular information on the tax aspects. So now, talking about the payment repayment structure. So this is a 19 months tenure deal, and with a fairly equated monthly cash flows. And if you would see, if we consider the upfront cash collateral and liquidity available with the transaction, the investors will be completely covered after 12 months. So considering the regular cash flows and the available liquidity, you if you invest in this transaction, you will be fully covered once after the cash flows of 12th month. And if we do not take into account cash collateral or the security package available, the money would be you will be covered in 17 months if we only consider the cash flows, right? And if you look at monthly cash flows, every month you will be repaid somewhere to the tune of 5 to 6%, which is also visible in the third or fourth column with the heading total repayment, right? So in a 1.1 multiple, the cash flows are split in this fashion, wherein 5 to 6% is getting repaid every month. And as the pool amortizes, as the cash flows, as the principal outstanding goes down, you would clearly see that the upfront liquidity as a percentage to outstanding principal keeps on increasing. Therefore, in the last column, it's clearly visible that the OC and CC, which provides upfront liquidity, was 22% in the first month. And as the principal amortizes with the monthly repayments to investors, this keeps on increasing. And if you look at 13th month, it will be 50% of the outstanding principal, which is a very significant number to look at from a safety perspective. So that's how your cash flows or your returns will be structured during the course of these 19 months. And yeah, uh, that's how your cash flows will be distributed.
Yeah, thanks, Rishabh. Quickly, just wrapping this up. So, fairly homogenized amortizing structure of principal and interest. The couple of landmarks are at 12 months, your 100% of your capital is de-risked, and the payback period fully is between 16 to 17 months. And the last point is that the security cover keeps on increasing as percentage of your principal invested as you go along the tenure of the instrument. Um, if we can, Rishabh, if you can just also talk about the key risks and mitigants for investors in a structure like this.
Yeah, yeah, definitely. So two key risks which are there in this transaction are repayment of interest or loans in this transaction, right? Which is somehow mitigated because the underlying pool is diversified, and as we discussed earlier, the ticket size is also very small, right? In between 35,000 to 60,000, majority of the pool is of that ticket size. But yeah, there are 4,000 plus borrowers in the underlying pool, and supposedly if you invest 1 lakh in this transaction, your average exposure to one loan will be only 25 rupees, right? So therefore, that risk of repayment of underlying loans is covered by the diversification available in the transaction. And if you look at if we talk about the repayment of loan only, then also due to the security package available, there is a liquidity of 22% of the loans, 22% of the outstanding principal which is available in the transaction. So if uh, any circumstances happen or due to any exigency that there are defaults or delays, you are covered to the tune of 22% of the loans. And due to excess interest spread which is available, your interest repayments are also covered to the tune of 56%. If the overall interest repayments are impacted to up to 56%, your cash flows will not be impacted in any manner due to the additional liquidity available because of excess interest spread. So this is how the security package which we spoke about would play out and would cover the investors in case of uh, any circumstances which are not favorable.
All right. Nikhil, I turn to you on a question that I was hoping to see in the Q&A box, but I haven't seen till now. At the end of the day, in this, particularly in the LoanX Vedika opportunity, the loans are finally lent to individuals at the end of the chain. How is it different from P2P loans then?
Yeah, thanks, Above. That's something that we have obviously got multiple times, and very happy to provide that answer. I think somewhere that was also a key question for us as we started designing this instrument and something we wanted to solve from. I am just going to quickly share my screen to also talk about not only P2P but also bonds, because that's another common question that investors do have. Just give me a second, please. Yeah. Perfect. So coming to your question first, I think P2P is a product which today allows investors to invest in a pool of loans. The big difference, similar to how the LoanX is, the big difference is that there is no security package provided, no cash collateralization, over collateralization, or excess interest spread provided by the P2P platform. And hence, if there was to be any impact in any of the loans that an investor is investing in, that flows entirely to the investor. I think that is really the big difference between the two products. I think the smaller differences are that the P2P product is still not a listed product, it's not a rated product, and it's not held in your demat account. All of those advantages do exist from a LoanX product. On the other side, the LoanX product does have a higher ticket size than a P2P product. A P2P product does allow you to invest in much, much smaller ticket sizes than LoanX. So these are the key differences between a P2P and a LoanX product.
Understood. And the LoanX Kirtana opportunity, that was the pool of loans were MSME loans. So maybe we can spend like 30 seconds on the difference between LoanX Kirtana and the bonds of those NBFCs as well.
Absolutely. And that's what we've tried to depict in this slide here. Many of our users are familiar with the NBFC bonds that we have on the platform and purchasing those and asking why should we buy one or the other between LoanX. To us, both the instruments represent slightly different risk returns, and an investor should have the correct information and then make the choice on what they want to invest in. In the case of a LoanX transaction, your investment is very specific to a defined pool of loans, and it is selected based on identified criteria. In the case of an NBFC bond, the repayments from the entire book, whatever shape it may be, right? Good loans, bad loans, whatever it may be, is linked to the repayment of the bond. The originator or the underlying issuer actually tends to be the same. It is the same NBFC. The security package, however, is very, very different in case of a LoanX transaction. There is a very specific security provided in terms of cash collateralization, over collateralization, EIS. However, in the case of NBFC secured bonds, it's on receivables. That is all the future receivables of the NBFC. I'm picking up some of the main points, Vaibhav, in the interest of time. I think the questions like bankruptcy are another important one. Because the loans have been assigned to the trust, the bankruptcy of the investor, bankruptcy of the NBFC actually does not impact the investor. However, in the case of a bond, a bankruptcy of an NBFC does come and impact all investors because everyone is treated at par. In the LoanX, they're treated differently. From an investor return perspective, the LoanX provides not only monthly fixed interest, but also principal back. Most bonds, however, provide interest on a monthly or quarterly basis, and principal actually comes at the end of the life. This results in faster repayment and better security of the LoanX versus the NBFC. Tenures for both are in the similar range. The LoanX, because of being a structured product, does offer a slightly higher return, even if the rating of the product is slightly better. So even if the rating agency has rated it better, it still provides a slightly better return. So these are the main differences between an NBFC bond and a LoanX product.
All right. Um, let's move on to the Q&A box, and I will just take the first question in continuation of this topic, which is Sunny is asking, are you trying to say that LoanX will be more secure compared to P2P?
Yeah, I think Sunny, the first of all, from a theoretical basis, I think there are two things to keep in mind. One is how many loans form part of the LoanX and the P2P. If we told you that the LoanX consists of 100 loans and the P2P consists of 10,000 loans, I would say that the P2P is far more secured because it's far more diversified. I think the question is not just at the surface level of P2P versus LoanX, but really what does that constitute? I think from our perspective, 2,000, 4,000 loans is sort of the minimum of where we will be at from a LoanX diversification perspective, which gives us significant diversity. I can't comment for all P2P platforms, but I think this is similar to the range of diversification that they offer. On the cash collateralization, over collateralization, I think it goes without doubt. There is no question that the LoanX on that matter scores above the P2P product. And from that perspective, will offer much higher security. I think the third thing is the quality of the NBFC. The NBFCs that we're talking about, especially like, for example, Vedika now, has been in the business for 15 years, has a 0% net NPA as of today, after being for 15 years in the business. That goes to explain the quality of work being done by the NBFC, not only in giving loans, but collections, and plays into how secure the product will be. Most P2P platforms today have about a 5-year life, have had a 5-year life. So these are the differences to look at. I don't think it's as easy as LoanX, and I can assure you, Weber will not like me saying this, but I can assure you that other platforms will also offer LoanX in the future. And as investors, as you look at this product, please look at what goes underlying it in terms of the number of loans, the history of the NBFC, and the security package.
Yeah, absolutely. One question I don't see this question. Okay, I think it is answered, but I just want to take that question. So we mentioned that the TDS component on this is 25% for individuals. Usually the TDS is 10%. Why do we have such high TDS on all our products?
Yeah, it's something that we are not happy about. We would love for the TDS to be at 10% in line with other corporate bonds, if possible, even lower. However, the TDS of 25% is the regulatory requirement that has been set for SDI products. We are writing and making an appeal to the respective bodies to consider a lower TDS for the products to be able to make them more investor friendly. As soon as that change happens, if it happens, we have no control over it. We will be able to reduce the TDS. But as of today, this is a regulatory requirement. Obviously, you understand that TDS is something that gets adjusted against your annual taxation. It does not mean that it's a double tax. Your tax is your marginal tax rate, and the TDS will get deducted from any other tax obligations that you have, or will get adjusted against any other tax obligations you have at the end of the year.
Okay, another question on tax. Denver is asking, what's the post-tax IRR for the first LoanX product? I would just say that the post-tax depends on the marginal tax rate of investors. If we take 30%, then Rishabh, do you have it on the top of your head on a 13% pre-tax? What would the post-tax be?
It would be somewhere around 10 to 11% on a post-tax basis, for that, because the 30% tax only applies on the interest coupon and not on the principal repayment. So it is really the on the 1.1x, it's a 30% tax. On the in the 0.1x, it's a 30% tax.
Hemant has asked a few questions. I think most of these questions revolve around the risks involved in terms of the loan portfolio. I would try to concentrate it in one question, but I think there's one more question on the IRR for these microfinance loans is very high. And I think that's where the excess interest spread also comes in. that the loans are eventually lent at 24, 25%, maybe more, then why are the rates offered to investors of LoanX so low, considering the fact that they ultimately carry credit risks?
Yeah.
I think it will be a repeat of our security package, but I still want to take this question.
No, I think it's a very important question. And Hemant, I think there are different risk appetites, right? We could come to you and tell you that, hey, we'll give you the full 25% return, which is on the underlying loan, but then there is no security package, right? If anything goes bad on that loan, you as an investor will get impacted. I think what we're trying to do here, working with the NBFC and very much in line with industry standards, best in class industry standards, is to say, let's reduce the risk of the instrument and still be able to offer a very competitive return for that risk. That reduction in return in risk is being done by the NBFC bearing the risk of default and them cuffing up the cash collateral, the over collateralization, and saying that that even if there is a default, the full interest first comes to the investor, right? So at all stages, the NBFC is junior or has an inferior investment to your investment in this product. For them to make money, you have to make money, which obviously means your returns or our returns as an investor are lower than their returns. That is sort of the balancing act that is done. We are giving away some of the returns for a higher degree of security. And this, in our view, creates a more balanced instrument.
Yeah, and I would just say it in a different way, that even though the loans are lent at a 22, 23, 24%, the instrument is an A-rated instrument. There is no way that bridge can be crossed in terms of risk reward, right? Having said that, as an A-rated paper, above 12%, 12.5% returns still beat the other comparable A-rated products in the market. So that's how we are finally fine-tuning the risk reward spectrum for our investors.
I think there was a question by Hemant regarding how such instruments have performed historically, right? So I would like to take that. So based on a very recent report issued by CRISIL, similar rated instruments, which are A-rated instruments, historically have the cumulative default rates on such instruments for last 1 year was only 0.6%, which is very minimal, right, if we compare it to the available security package. So yeah, so CRISIL and all the rating agencies always issue a yearly update reports wherein they report the performance of these instruments. So the cumulative default rates were only to the tune of 0.6% historically, and if you look at cumulative default rates for last 2 years, it was, I think, somewhere around 2%. But again, the available liquidity or cash collateral is much higher if we compare it with the history of defaults.
Okay. Denver has another question which says, is this product a collateralized debt obligation? Who wants to keep on it?
So Denver, I started my career in the middle of the financial crisis in an investment bank. So I have had the unfortunate history of dealing with some of this. I very simply, the answer is yes, right? This is a collateralized debt obligation. It's a CDO, but I don't think CDO is a bad word. I think what you put in a CDO really defines what happens. For all of us, we know the global financial crisis. The CDOs that crashed were the ones that were made of subprime loans, packaged and sold without necessary security cover, and then that is the ones that defaulted. I think what we're talking about here, and those were what was called junior tranches, right? So there was the top tranche of a loan, and there were junior tranches. What crashed were the junior tranches of those loans. The tranche that we have here, and both the credit rationale and the information memorandum mentions this is an A1 tranche. It is the highest tranche of the structure. connecting it with Hemant's point, all other tranches which provide the higher returns and have the higher risk are the junior tranches. And that is not what this product is about. So it is a CDO, but it is a CDO of the highest tranche of the underlying loans, and hence it's something that we believe is a good risk reward for investors.
Yeah, I think it's well put when you said that CDO in itself is not a bad thing, but it is really what goes into it. Okay, one question that I still want to take from Hemant is, what are the legal opinions for investors in case of defaults and repayments? Or let me just put it this way: we know that there is a security package there, and maybe you can talk about that. Like first first few defaults on the loans does not really result in a default of the instrument. And then what happens when the instrument defaults? Will Grip Invest help, guide? What is the role?
Yeah, absolutely. So Hemant, let's and just to sort of quantify when this would happen, the first thing that would happen if there's any default is that the excess interest that is available, the 15% or 14% excess interest, will be used to cover any delay or default, which is significant, right? It's almost equal to the coupon. So you have to have more than 50% of loans delay to not be able to meet interest obligations. If it goes beyond that, there is a 5 to 10% cash collateral available with the trustee as a fixed deposit, which they have complete authority to dip into. So there has to be up to a 5 to 10% NPA. And just to note, neither of these NBFCs have anywhere close to that in terms of the net NPA. Let's assume that even that gets crossed. Then there's a 10% over collateralization, which means 10% additional loans assigned to this. So nearly, very roughly speaking, 20 to 30% of the loan book has to go bad for anything else to be required. At that point of time, the trust, which is managed by a SEBI trustee, is empowered to act in the interest of investors. GRIP will obviously provide all support, and the trustee and GRIP will work with the NBFC to make better collections happen, etc., to pay back the investors. I do want to emphasize that ultimately the servicer of this book is the NBFC. GRIP does not have access or the ability to be able to go to each of the borrowers and try to recover the funds. That is not something that we claim to be able to do, or you should rely on us for doing that. What we will do is work with the NBFC in the best interest. From our perspective, putting together the security package and making that really robust so that a situation of going to the NBFC to then take further action is not required. That's how we're conceptualizing this product.
All right, great. This is one of those very, very few webinars where we have finished before time. Any other parting thoughts? Otherwise, we will wrap the session now. Oh, I guess there's one more question. Does GRIP invest?
Yeah.
Does GRIP invest in such opportunities?
Mr. Kelkar, GRIP does not invest as a company in such opportunities, but the employees of GRIP, including myself, Vaibhav, Rishabh, Vivek, all of us who are on this call, we personally do invest in these opportunities. In fact, I have personally invested in every single GRIP opportunity created on the platform over the last 3 years. That's something that we committed to do, and that's something that we will continue to do. Our investment amounts may be smaller. We may not be able to invest as much, but it's something that we make sure that anything on the platform is also something we are comfortable investing in personally. Yeah. I think I just, maybe to wrap up, Vaibhav, I think the product by itself is new to market. We're very happy to spend time with users to provide more understanding of what goes into the product. But I do believe that the combination of it being regulated by SEBI and RBI and structured in this manner, held in the listed rated form, does provide a very exciting risk reward. We'll be doing much more LoanX on our platform, and we'd be happy to spend time one-on-one with investors to give them a better understanding of the product.
Yeah, and just to add, you always have your dedicated relationship managers. Please feel free to reach out to them in case of any questions, queries, feedback, everything. And just before I go, this this Thursday or this Friday, we have another LeaseX opportunity coming up. Uh, it's been a while that we launched the LeaseX opportunity, so I'm quite excited about that.
Absolutely. Perfect. Thanks, Vaibhav. Thanks,
Okay.
Rishabh. Thank you, everyone, for joining.
All
Have a
right,
good
Thank
week.
you, everyone.
everyone. Thank you.
Thank you.